Before buying a stock, professional investors ask 5 important questions. They don't just look at a rising price, they investigate the business behind the stock. Today, we'll learn how to analyze a company like a professional investor. Imagine you want to buy a piece of a company. You are not buying a ticker symbol. You are becoming a small owner of that business. So the first question is simple. Is this company actually growing? The first thing investors study is revenue growth. Revenue tells us how much money a company makes from selling its products or services. A healthy company usually finds ways to increase its sales over time. Let's take Apple as an example. Over the years, Apple grew by selling more iPhones, Macs, services, and creating new products. Investors look at this growth to understand if the business is becoming stronger. But revenue alone is not enough. A company can sell more products and still lose money. That is why professional investors look at the second question. Are the company's profits improving? This brings us to margins. Margins show how much money a company keeps after paying its costs. Higher margins often mean the company has strong products, pricing power, or better efficiency. Apple is known for strong profit margins because customers are willing to pay premium prices for its products. This ability to earn more profit from each sale is something investors pay close attention to. The third question investors ask is, does this company generate real cash? Profits on paper are important, but cash in the bank is what keeps a business alive. This is called free cash flow. It represents the money left after a company pays for operations and investments. Strong free cash flow gives companies flexibility to innovate, buy back shares, or survive difficult periods. Apple generates billions of dollars in free cash flow every year. This gives investors confidence because the company has the resources to continue growing and rewarding shareholders. The fourth question is about risk. How much debt does the company have? Debt can help a company grow, but too much debt can become dangerous during tough economic times. Investors analyze debt ratios to understand financial health. They compare company debt with earnings and cash generation to see if the company can comfortably handle its obligation. After understanding the business quality, investors ask another important question. Is the stock price reasonable? A great company can still be a bad investment if you pay too much. That is why investors study valuation multiples, like the price-to-earnings ratio, also called PE. This compares the stock price with the company's earnings and helps estimate whether the stock is expensive or attractive. But valuation is not only about numbers. Investors also look for something called a competitive moat. A moat is what protects a company from competitors. Apple's ecosystem is a powerful moat. Its devices, software, services, and loyal customers create a strong connection that makes it difficult for competitors to replace the company. Professional investors combine all these pieces together. They analyze growth, profitability, cash flow, debt, valuation, and competitive advantages before making a decision. The goal is not to predict tomorrow's stock price. The goal is to understand the business and decide if the company deserves your investment. So before buying any stock, remember these 5 questions. Is the company growing? Is it profitable? Does it generate cash? Is the debt under control? And does it have a strong advantage? Investing like a professional is about patience, research, and thinking like an owner. The best investors don't chase trends. They understand businesses. Start analyzing companies and you'll make smarter investment decisions. If you found this video helpful, make sure to like this video and subscribe for more simple explanations about investing, business, and building financial knowledge. Remember, every professional investor started by learning the basics.